let's review a file that we recently closed in Long Island. It was a luxury property, and let's go through its specs here. So the property was recently renovated. It looks very luxury, very nice, spacious, and the property was sold above asking price. It was listed for 1.25 million, 4 bedrooms, 4 baths, and it was actually sold for $1.29 million. And the client put down 25% down payment, $322,000, and their monthly liabilities, right, which is the minimum payments that they have to make on their credit card, installment plans, or student loans, or car payments. They were on the lower end of $255, right? And there were 2 borrowers on the file, and we used the worst case one, right? Whoever has a lower credit score, husband or wife. So the husband had a lower credit scores of 779, and that's what we used for the lender. And household income, there was nearly $500,000. Both of them were in the medical field, and the property taxes were on the higher end for this one because you're buying a luxury property, more built, so the property tax is going to be higher, $21,000. And home insurance, we typically see it around $2,000 or less. This one is a bigger house, so the property insurance was more as well, $4,000 there. And they went with the 30-year elite high balance loan, and the interest rate they received was 6.99%. They did buy down the rate, and the APR was 6.549 here. And let's go through a CD that we actually gave them before the closing. So the loan amount was $967,000, and the interest rate 6.499. So the principal and interest was $6,114. If you're a first-time home buyer, you always want to pay attention to this. Can this amount increase after closing? You always want to see no's in there, okay? And this loan type does not have any prepayment penalty, meaning they can refinance, they can sell that house anytime they want, and there's no balloon payment, right? There will be no surprise of lump sum, so this way they have this fixed rate for 30 years, okay? Next we have is that along with their principal and interest, they added escrow account. Right, escrow account is great when we have to add property taxes and home insurance. So this way, when the property taxes are due, they come out from your escrow account. And when home insurance is due, it comes out from your escrow account, right? So collectively, their monthly payment is going to be $8,205, right? So their closing cost was $47,000, nearly $47,000 there. And cash to close was $301,000. Yes, I know total amount they're paying down is 322, but we're going to give you a breakdown of this, okay? So section 1, when you're comparing lender to lender, you want to go with origination charges in section A and see what are you paying for underwriting fees? $1,200, right? And they did buy down the rate a little bit for about $2,400. So section A, they have $3,637 fees there. Section B, these are the services that they did not shop for: appraisal fee, credit report, and others, $730 there. And then section C, these are the services that you did shop for, right? Your attorney hired a title company, and the title company is charging nearly $3,800 there, okay? Then your government fees, right? Every county is different, right? They have different rates, how much they charge when they're recording your mortgages, right? Do you have a mansion tax, right? Anytime you're buying above $1 million, you have to pay a mansion tax. All these things, fees, $22,000 went to taxes and government fees out of that $47,000 closing cost, okay? Next, you have your prepaids. These are the services that you paid for before the closing or at the closing. That includes your home insurance, right? $4,000. We did mention escrow account, but that's for the renewal time. So when you're starting off, you got to pay out of your pocket, and that shows on your CD here. Okay. Next is your escrow account that you're going to be paying monthly basis, but they're starting off with some amounts there. They want, lender wants to put down at least 2 months of home insurance in that escrow account to start off with, and 3 months of city taxes, and 6 months of village property taxes. And when you add that, nearly $7,700 is going towards your escrow account. It is your money, right? This money is going to be held in escrow account. So this way, you know, when your home insurance or your property taxes are due, it will be paid from this account, right? And this amount is going to keep increasing because you're going to be paying nearly $2,100 extra towards that account every month, right? And then you can see in section H, a lot of people miss this. It says title, owner's title policy optional, right? Even though it's optional, you always want to pay this. It is $5,200 in this case, but it protects you for life until you sell that property or refinance, or have an ownership of that house that nobody else can claim that property. So it's very important that you have this in file, right? And you pay for that. So their closing cost was nearly $47,000. They had the services that they paid for, home insurance beforehand, $4,500 there. And the total down payment they had was $322,000. But when you're signing the contract, right, you're putting down, earnest deposit, they put down $64,000 there. And then with some adjustments, they had to bring $301,000 at the closing table. So this property was definitely luxury. You see everything on the higher end. You see the price on the higher end, property taxes on the higher end, home insurance on the higher end, right? Because they're buying a luxury property. If you're trying to buy a house in Long Island, we have plenty of agents on my team that can help you out. Please get in touch.